Hi everyone, my name is Sergey Zotov and today I will explain how to make accounting posting if you have something simple as a plain vanilla forward contract on foreign currency. You should do it yourself if you're a company because it's simple and you don't have to pay your consultants thousands of dollars, euros for that simple exercise. Okay, let's get started. Let's assume that today, say December 31st, and the year, okay, 2025. And it's working day. And you decided that you need to buy forward contract for 10 million euros. Like that amount you will need in future to cover your expenses that will happen in 1 year time. And spot rate was 1.18 euro per USD. Yeah. And forward points was 200 basis points. Forward points. So your forward rate for the contract expiring December 31st, 26 was at the rate 1.2 euro to USD. These are the inputs, like just to emphasize and to make it a little bit more simple. This is 0 period. The rate, I mean the spot, is the rate where you can buy euro and sell euro at the same rate. This is just for simplicity reasons. In following videos I will try to add more practical examples here, because obviously bank sells you currency at one rate and buys that currency at different rate. This is called bid-ask spread. So in that way, bank can make profit. But let's assume like this pure simple example. So you can buy and sell currency at this 1.18 spot rate December 31st, and you've purchased that contract for 10 million euros, meaning that in 1 year time you will have to transfer 12 million United States dollars to get these 10 million euros. Simple, like simple as is. And nothing should be reflected at the December 31st. Why? Because we assume, and that's what we, by the way, do in our accounting, that you can sell currency and buy currency at the same rate. You're ignoring bid-ask spread. So that means that at this date you can close the contract without any financial implications. Okay, what happens in your mid-year reporting? June 30. Up 26. 2026. Let's play with some parameters. So let's have spot 1.15. Forward points are the same. Again, just for simplicity reasons. But as closer we go to the value date of December 31st, 26, the less forward points you have to pay to have the contract. So at that point of time, you're buying 6 months forward contract. And that decreases your forward points you're paying for it. Okay, let's make it real. Like, I mean, let's have it 100 forward points. Now, at that point of time, you might buy the same contract for 10 million euros with the value date at the end of the year. Way more beneficial for you because you need euros. Your all-in rate gonna be 1.16. What does it mean for your contract you already concluded before? That means you don't want it because you can buy better one at the market, but you are bound by the contract agreement. You have to keep it, or you might close it. You might close it at any time by buying an offsetting contract with the value date of your original contract. And that's what you are reflecting in your accounting entries. So here your contract is less beneficial than current market conditions. So that means you have to pay something to get rid out of it. And paying something, it means liability. Because obviously you are not gonna close it, but if something happens and you have to close it, you will have to pay some amount of money. Let's calculate what the amount you will pay to close this contract at the end of June 2026. Okay, what's happening at the end of 2026? You will have to transfer 12 million USD. So it's obligation, it's written in your contract, you're transferring it. And you're receiving 10 million euros that you don't need anymore, for example. So this is your outflow. Let's put minus here. And that's happening in the future. To close it, you should buy an offsetting contract where you receive that amount of United States dollars in the future. December 31st, 26. Okay, and you have your parameters here, this and this. So let's do simple math. And that's so the question here, how much euro do you need to sell to have that many of United States dollars in the mid of the year with the value date in the future? Okay, so it's basically that simple. You are dividing this one by 1.16, your current conditions, and you are getting 1.16. You will have to transfer 10,346,828 euro. So you're buying an offsetting contract with a delivery of 10,344,828 euros with this value date. And it's more when you will receive at your initial contract. And the difference between this amount and these 10 million is basically your liability at the mid of the year. So your liability, and that's where we go to accounting entry. You simply put an entry at June 30, 26 as this hedge liability. Of 344,828 euro. Okay, and you convert it in your functional currency, obviously. And this is with minus because this is liability and an offsetting. And another leg of the entry goes to other comprehensive income if you're under the hedge accounting. €8 to €8. That's simple. Like, that's it. That's what you have to reflect at the middle of the year into your interim financial statements. I will exactly tell how to treat it under hedge accounting, because otherwise it will not go to other comprehensive income, it will go to profit and loss statement. And this is also an option, but this is for separate discussion. Okay, let's move to the entry that you will have to have at the end of the year. So let's discuss it. Okay. Okay, continue. Continuing December 31st, 2026. That's where you get your 10 million euros and you pay your 12 million United States dollars. Okay? So, but what is the spot rate? Spot is 1.25. Let's assume that you were extremely lucky, that your spot rate is worse that you initially hedged, and you're better off with your hedging. But it doesn't matter from the hedge accounting, but it's just for the sake of this example. Okay, what accounting entries do you do here? First of all, these entries, this entry, this is balance sheet. Let me put it here. It's balance sheet here. Whoops. You're reversing it. You don't need it anymore because it's already gone from the perspective of time, and it's already different. And at that point of time, you don't have any asset or liability because you're receiving. Okay, let me write it here. So it's debit euro 10 million 1, 2, 3 1, 2, 3, and it's credit USD. It's all bank accounts, different bank accounts. Okay, now let's play with the rates. You will receive this. Your system will automatically apply some kind of spot rate. Let's assume that this is the system rate. So it applies 1.25 here. So, but where the difference goes to? It goes to FX. Be patient with me. I will write it with in United States dollars in a second. So this is USD, this is Euro. Let's convert it. It's gonna be 1, 2, 5, 1, 2, 1, 2, 3. 12,500,000. And the forex here, this is PL, so that's why it's with minus 500. Sounds like a great deal. So you got a way more beneficial rate than the market rate. But this is system setup in terms of entry. You have to do additional entry to complete your hedge accounting. At the beginning, you committed to that 10 million euros to make your operating expenses fixed at the level of 1.2. So you are fixing in advance your OPEX at 12 million United States dollars. And now here, it's not OPEX anywhere. You have some kind of OPEX here that lives its own life, and it's a different trade. It's at some average rate, and you have to do this OPEX equal to your rate here. So what you do? You basically moving these 500 from FX that was system generated to OPEX. So you do the posting debit FX and credit OPEX. And that's it. Like, that's all what you need from the accounting entry perspective. There are a lot of other elements hidden inside. I will dedicate several videos to show what are the difficulties inside and how to document and where to get information from. But the basics here. So basics is 1, 2, 3. What you need to know. First, you're buying the contract. Period 0, when you're buying it, nothing happens in your reporting and in your accounting. Interim period, your interim reporting date, you have to value your contract. What is the value? And I prefer to look at this as what amount of money I'm receiving or I'm paying if I want to close, to wind down my contract in the interim date. That's simple. Like, and this is provided by brokers. I will show where to get this information. It's simple. Like, if you have broker, you can get the information. It's either mark-to-market report or from your online portal. And the last date, it's system generated entry, and you're correcting your OPEX to have your OPEX as it was designed 1 year ago. 1 year is in our particular example. Here we'll discuss what's the system rate, what's the spot rate, what's the bank rate, and which rate we are using here, because it's not that clear that game with the rates, because I mean, we are always simplifying here with 1.90 spot and here with spot, but spot is a range of different rates. You have your system rate, accounting system rate, you have your bank's rate, you have your broker's rate. you have your Google rate. Which one to use? I will explain. That's another interesting conversation. And you have your average system rate. That's also important. Okay, cheers. Hopefully it's a little bit helpful for you. See you soon.